welcome to the Hurst Trading Room Live. My name is David Hickson, and it is the 19th of October 2015, 2 p.m. in Central Europe. And this weekend we have daylight savings changes, so please make sure that you are familiar with the changes that are happening in terms of time. We will be doing the webinar at 2 p.m. Central European time next week to keep things simple. So if you're not in Europe or the United Kingdom, then please make sure that you check what time it is that we're starting next week. As always, before we take a look at the markets, please make sure that you have read and understood these disclaimers. What I am going to be doing in this week's webinar is following in the footsteps of last week's webinar, and I'm going to be speaking about the analyses that we've looked at so far in these webinars. I'm going to be updating the analyses and speaking about some of the details and the subtleties, answering whatever questions you might have. And I'm also going to focus a little bit more on the Composite Model line. There's been a great deal of interest in the Composite Model line, which is a new feature in Sentient Trader that we are busy testing. And it's a really interesting line, but it can be a little misleading, and it's important. And so I've started speaking about it in these webinars, so I'm going to focus on giving a little more detail on that to make sure that everybody really understands what that line is. First of all, let's start with the S&P 500. These are the ES futures, and I'm not going to start sort of right from the beginning. I'm just going to take a look at some of the analysis issues that we're dealing with at the moment, so that we can work out what we're expecting from this market over the next few weeks and over the next few months, because I think it's quite useful to look at sort of various different time frames and ask ourselves what it is that we're expecting. First of all, this is the default analysis that Sentient Trader has performed. I can turn my pen on. I can show you some of the details. First of all, the default analysis, as you can see, has an 18-month cycle trough over here in the middle of October 2014. And of course, price bounced out of that 18-month cycle trough very sharply and exhibited the way in which stock markets tend to demonstrate the principle of synchronicity, which is that troughs are synchronized. They tend to plunge very sharply into troughs. Of course, we can't see the plunge into this trough, but I'll zoom out in a moment. Then they bounce very sharply out of the troughs. And then when they form peaks, they tend to form rather complex and generally rounded, what I call clustered and rounded peaks. So you can see a good example of that happening here in the S&P 500. Let me just zoom out and we can actually see that a little more clearly. There we go. You can see the sharp plunge down into this trough and the sharp bounce out again. And you can see how of this cycle, and in a moment we'll discuss what the magnitude of that peak might be. But the peak of the peaks that have been forming there have been generally clustered and fairly rounded, and that's something that you very often see in stock markets, and that's because troughs of cycles in stock markets are synchronized. That's the principle of synchronicity that we spoke about. And of course, we had this very sharp drop at the end of August. Just as we were wrapping up our summer holidays, that very sharp drop at the end of August was a drop down into another trough. Now, let's speak about that trough and what the magnitude of that trough is. This is the default analysis, which means that I've just let Sentient Trader perform its analysis. I haven't really interfered at all. I don't think I've pinned any troughs in this particular analysis. I might have, but this is the sort of standard default analysis. It's just doing it out of the box. I find it very useful to look at the default analysis, and whether it's right or wrong isn't really very important to me. What's important to me is that I just want to see what Sentient Trader is saying about the market, and then once I see what Sentient Trader is saying about it, we can start looking at possible alternates. As I've mentioned many times before, Sentient Trader often performs a better analysis than I do, and so I'm really quite interested in seeing what it has to say. So Sentient Trader has labeled this October 2014 as an 18-month cycle trough. And as a matter of interest, people often say to me, at the moment, Sentient Trader is looking back a year and it's saying that was an 18-month cycle trough. That's fairly easy to do. How soon after the formation of that trough did you think that might have been an 18-month cycle trough? Because obviously, the sooner you can identify a particular trough, the more quickly you can make appropriate trades because of that trough being in that position. And in this particular case, it was an expected trough. Of course, we were seeing the nest of lows there, and it was only a week or so after the formation of that trough that I started thinking that it was probably a trough of the 18-month cycle. So it's a quick little answer to that question that does often come up. And so the next really big trough that Sentient Trader has analyzed or phased is this 40-week cycle trough over here at the end of August. Now, there is a debate. If you've been coming to these webinars, you'll know almost every week I speak about is that a trough of the 40-week cycle or isn't it? And there are a few possibilities. One of the things that I always like to do is I measure the cycles after Sentient Trader has phased them, and I take a look at that cycle and I see it is 316 bars, 316 days, that's 45 weeks. Now that's a long 40-week cycle. The average length of a 40-week cycle is 274 days. That's, if I move my mouse very carefully and your eyes are good, that's over there, 274 days. And as you can see, there is a trough over there that was in July, I believe, early July. And so one of the alternate possibilities is that it's a trough of the 40-week cycle. But now, when we're looking at a particular analysis, it's useful to take a look at the analysis and work out whether what we're seeing at the foot of the chart, in other words, the analysis information over here, represents fairly closely what we're seeing up in the price movement. And what we expect to see are the M-shaped cycles. So we expect to see a big bounce up, a drop down to an intermediate trough, a bounce up to the next peak, and then a drop down into the final trough. So we're seeing a good M shape there for the 40-week cycle. That looks fairly good. I see a comment from David. It's also too long given the larger cycles are actually running shorter. So that's a really interesting point, because the larger cycles, the longer cycles, are running short at the moment. If we take a look at, in fact, you can see it on this particular analysis, the recent wavelength of each of these cycles is presented at the right-hand edge of the chart. You can see the 54-month cycle has been calculated as running at 50.5 months. In other words, it's running shorter than average, which is 54 months. And John's agreeing with that. And the 18-month cycle has recently been running at 16.8 months. And that's also shorter than the average 17.9, roughly 18 months. So because the longer cycles are running shorter, it is more likely that the 40-week cycle will also be running shorter, because when the cycles are running shorter, they all beat together, of course. It's a big complex network of cycles that all beat at the same time. They go up and down. And so if the longer ones are running shorter, then most probably the shorter ones are also running shorter. But let's just sort of press ahead with this analysis, because I quite like to have a look at an analysis and discuss it and consider what has happened since then, and see what it tells us to expect. And I have a bit of a punchline. I'm going to spoil the joke by giving you the punchline now. We're going to look at the three analyses that I think are most likely. In fact, there are four of them, four likely analyses in the S&P 500, and we're going to see that all four of them are telling us to fairly similar things. So in terms of making trading decisions, we can still make fairly confident trading decisions, even though we have four different analyses. And so that's really going to be the main thread of today's discussion, because I love it when different analyses start coming together, and it stops really mattering which one is correct, because we can make confident trading decisions regardless of which analysis is actually correct. And that is perhaps the feature of performing cycles analysis that I love the most. You know, I spent a lot of time trading using Elliott Wave. Not that I want to, run Elliott Wave. I think it's an extremely useful analysis process. But I spent a lot of time trading using Elliott Wave, and I found it very difficult because when I had alternate analyses, I ended up having two completely different possibilities that I was considering trading, and I found that very difficult. Using Hurst cycles, you will often find that, in fact, two different analyses will end up giving you very similar, not identical, but very similar trading decisions or trading possibilities, and that's what I'm going to demonstrate today. So I've given you the punchlines. You already know what I'm going to say. But let's take a look at this analysis in a little more detail. Let's measure from the 40-week cycle trough over there to this 40-day cycle trough. And in fact, let's just zoom in and have a look at what's happening here. If we measure from this 40-week cycle trough to this 40-day cycle trough over there, that's 34 days. That is the perfect average length of a 40-day cycle. In fact, it's actually 34.1 days, I believe. And so that is a perfect 40-day cycle that has formed there. So it's absolutely certain, in my opinion, that perhaps it'd be interesting to see if other people have other opinions about this. But in my opinion, it's absolutely certain that this cycle from the last week of August until the end of September, that cycle over there, if I can draw an arrow, that cycle over there is almost certainly a 40-day cycle. How it fits into the bigger picture could be debated a bit, and we'll do that now. But that is certainly, in my opinion, a 40-day cycle because it has the perfect average wavelength for a 40-day cycle. What do we expect to happen after that? Well, of course, we expect price to come down. Let me just clear that counter. We expect price to come down into the 80-day cycle trough, and here's the nest of lows for the 80-day cycle trough. So this analysis, let's draw our M shapes. I do love drawing my cycle shapes on the chart. I'm going to have to create an indicator that does it for me. So we're expecting the 80-day cycle, the trough of which is expected in the first week of November, roughly. We're expecting the 80-day cycle to bring prices down into a trough in the first week of November. So we're looking at a move downwards for about 3 weeks. That, in essence, is what this analysis is telling us. Of interest, I've been introducing the composite line to you recently. So let's just display that composite line, and I'll try and answer some questions about the composite line. We're getting a lot of questions about the composite line because it's a very interesting line. Just a reminder of what it is if you're not familiar with it. The composite line takes all of the cycle information that Sentient Trader has, and the cycle in trader has is fairly. It of course knows where all the troughs occurred. It is able to, of course, measure the wavelength of each cycle. It is also able to measure the amplitude of each cycle, and the amplitude of a cycle is something that we don't speak very much about generally. And so the composite model provides us with some interesting insight, showing us the amplitude of those cycles and how they're changing and so on. The composite model takes all of that information and combines it and produces a line which is simply the mathematical result of taking all the cycle information that it has and putting it together. So it's almost as if they were taking away the price, and we're saying to Sentient Trader, okay, now show me what your analysis tells me was happening in the markets. Okay? So that's really what a composite model is. It's the composite of all those cycles. I see Robin saying, is the composite line using both troughs and peaks? Yes, it is. That's quite an important point. Now, using Sentient Trader, you can display peak analysis as well, perform a peak analysis as well, and it generally increases the accuracy of composite model. Not always. Sometimes your peak analysis is simply not very good because, of course, you, particularly in the stock market, you don't expect to get synchronized peaks. So the peak analysis sometimes doesn't add any particular value to an analysis, and it's quite important, I think, to consider both and ask yourself, does the peak analysis add useful information to this, or is it just nonsense? Is it just noise? Because sometimes it can be. Although in my experience, and I've been playing around with the composite model line for almost a year now, I think longer than a year. I've been playing around with this, and in my experience, generally a peak analysis adds extra information which is useful. Nagaresh, is the composite line available to old users? Yes, yes it is. We don't have any age limits. It is Nagaresh, the composite line is busy being beta tested by some brave volunteers who are beta testing the composite line, and we are ironing out all the bugs and trying to get rid of all the problems with it. There are problems with it, and as soon as it's available, it will be released. If you want to be a beta tester and try that out, then send Sam a message, and he'll get you set up as a beta tester. Okay, so that's what this composite model line is doing. Is showing us, beg your pardon. Let me just zoom out, and I'm going to demonstrate something interesting and quite important about the composite model line, and that is that it moves up and down on the chart. The absolute price level for the composite line is not really what's important. What's important is what the composite line is telling us is going to happen to the movement of the market. Nagaresh is going to wait for it. That's probably a sensible decision. And composite line telling us, this composite line is telling us that we are expecting a move down of about that many points, or that degree a move. So from about 2040 down to about 1960. Remember, the composite model line does include information about the amplitude. As a matter of fact, we've identified a bug where it's increasing the amplitude of some of the shorter cycles too much. So if you're working with the beta version, don't take that seriously. We're fixing that. But it does work with the amplitude of the cycles. So this seems to indicate that we're looking at a drop of about 70 points. Is that what you call a point? From 2040 down to 1960. But the specific price level is not actually important. And the reason for that is because the composite model line is actually a floating line. What Sentient Trader does is it takes a look at the composite information that it has for the amount of chart that you are displaying. Okay, and then it reads that information, and it says within this period of, in other words, according to this zoom scale, from the beginning of August until the current day, what composite model information I have using the cycles that I've selected to include in the composite model. And it says using these cycles, this is the relative movement that we would have expected from the cycles. And it does not attach that line to a specific price point. What it does is it simply centers it on the chart that you see displayed in front of you, because it is indicating to you the relative price movement. So in other words, the cycle model that Sentient Trader has in it indicated that it expected a price movement from this level on the composite model line, or CML, we've started calling it, up to this level. So that was a move from 1920 roughly to about 2060. So that the cycle information in that period was indicating we should expect a move up of, and I've now forgotten it, was it 80 points? No, a little more, 1920 to 2060. That's 140 points, and so the cycle information that Sentient Trader has indicated a move up of 140 points. In fact, from the sort of low price here of about 1860, that would have meant a move up to 140 points to 2000. So here's 2000. So in fact, we did see a move up, which was of the same magnitude as the composite model line was telling us to expect. I hope that's clear. A point about the composite model line. It's not showing you exact price levels, but it is showing you moves, direction of move and degree of move over a particular time period. So as I've just demonstrated, from the last week of August until about the middle of September, the composite model was telling us to expect a move up of about 140 points. And we did see a move up from the low in the last week of August of about 140 points. There's no big surprise that the composite model line is showing us a move up that was fairly accurate because, of course, Sentient Trader has that information. Okay, it has the price information, so there's no big surprise that what it's working out is fairly close to what happened. Because remember, the composite model line is not a projection that was made 3 months ago and is now displayed upon the chart. Quite an important point. Okay, so the composite model line tells us to expect a move down. And of course, the composite model line is very much about time. So the peaks occur at the time that a peak is expected to occur, obviously, because Hurst cycles deal with price moving. So we are expecting a move down here of about that magnitude. And I keep forgetting what that magnitude is. That's about 80 points. So I'm expecting a drop of 80 points. We should try and write it. And then in the beginning of November, because we're expecting an 80-day cycle trough at the beginning of November, we're then going to get a move up, which is going to be a bigger move up. And we're going to see a peak forming around about the middle of November. Then we're going to see another peak forming over here. Can you see that? That is in about the middle of January. Wow, that's a skew line. In about the middle of January 2016, we're going to see a second peak form. And now let's just zoom out and see what's going to happen after that. Right. Now, do you notice how the composite model line has jumped up? Because, as I've just mentioned, it's a floating line and it gives us relative price movements, not exact price movements linked to any price. So the composite model line that we're seeing now has a low point over here, which is pretty much at October's low. And it tells us that according to the cycle information that it has, the cycle model that it has, it was expecting a move up to about this level here, 2200. Okay, do you notice what actually happened to price? Price started sort of lagging below the composite model line. That's quite an important thing. It tells us that the cycle model that Sentient Trader has was telling us to expect price to be a little bit higher during this period, in which price has disappointed us and has dropped down. And you can see it's dropped down by a distance. So that discrepancy is not explained by the cycle model that Sentient Trader has. What would explain it? Well, what would explain it, of course, is a shifting of sigma L. Sigma L is the sum of all the longer cycles and what they're doing. It's very difficult to calculate sigma L. Sentient Trader does calculate it and it does project it. But when you start seeing price deviating from the composite model line in a consistent fashion, as it has been doing here, then it generally indicates that actually sigma L is probably turning bearish more than Sentient Trader has expected it to. which is generally a bearish sign for the markets. It's quite important to bear that in mind. Generally, that's fairly bearish. So what are we expecting to happen now? What's my trade for this week, for today? Well, here is that downward move, and it's still got the same price scale, of course, because it's working with the amplitudes of the cycles. So it was 80 points. So I'm looking for an 80-point drop in price. I'm not saying it's going to happen today, but it is expected to happen fairly soon. And then we're going to come into the 80-day cycle trough over here. Okay, and then we're going to see price bouncing out of that 80-day cycle trough, and we should get a good long trade. We're looking at a peak occurring in November. Was it middle of November? Yes, I think it was about the middle of November, and then a second peak occurring over here in about the middle of January next year. And then this is the worrying move. Can you see that strong, deep move down from May of next year all the way down to a low point over here, which is in about the middle of next year. Now, that is what this particular analysis is telling me. For making my own trading decisions, I am interested in taking advantage of this short trade coming up now. I would want to trade this short move. Then I would want to trade this long move. Then I will reassess things, because then we will have seen a bit of price action, and we will have had a chance to rebuild the composite model. We'll see what's happening. But something that I'm certainly standing by for is peak in roughly middle of January, and then I'm looking at going bearish. So I can plan my trades a fairly long way out there. I see Williams asking what's the shortest wave I have included in the composite model line. Let's just have a look. I don't know. I think it'd be 40 days. 40 days, yes. The 20-day. Then what happens is I get a lot more little wiggles, as you can see. If I include the 10-day, then we get just a noisier line. The advantage of the composite model is because, of course, it follows the rules of Hurst's principle of synchronicity and all that kind of business. You can cut out the shorter cycles and you see the slightly bigger picture. The shorter cycles don't change the bigger picture; they just add a little bit more noise into what's happening. Okay, so that is this analysis. In terms of actually making trading decisions, you know what I'm going to say. I'm going to put up the FLD, and here's the 20-day FLD. And of course, the interaction that we're expecting now is the F category interaction, where price drops down below the FLD. So I am standing by to make that trade. I'm expecting to come down to this 80-day cycle trough, 80-day cycle nest of lows over there, and as price crosses down through the 20-day FLD, that would be my trading signal to jump into that trade as it crosses down below the FLD. Now, the F category short trade, for those of you who trade using the FLD trading strategy, which is one of many trading approaches to trading using Hurst cycles, so I don't only speak about that in these webinars, but if you do trade using the FLD trading strategy, you will know that the F category short trade is very often a very good profitable trade. This trade over here, if you had the analysis correct, was an F category short trade. As a matter of interest, if you had the analysis wrong, as I did at the time, then that was in fact a D category short trade, which turned out to be a fantastically, surprisingly profitable D category short trade. It was really a really good trade, which kind of brings me back to the theme, if there is a theme for today's webinar, that even if you get your categories wrong in terms of trading the FLD trading strategy, generally you're making the right trade in the right direction at the right time. You might be calling it an F category trade or a D category trade when actually it's an F category trade, or vice versa. But the point is you're making the right trade. You're in a profitable trade rather than a losing trade. Okay, so that is this analysis. Well, I've spent half an hour speaking about one analysis and one instrument. Just get a bit of on here. Okay, the other possibility for analysis, and I'll speed I'll speed up with this. I see William saying 40-day is very dominant in your approach. Okay, that's great. I presume William was saying 40-day is dominant. Are you saying it's dominant at the moment or just generally? Because certainly it looks as though the 40-day cycle is very powerful, very dominant. It's also historically my favorite cycle for the last year. There we go. So for the last year, the 40-day cycle has been a very strong, very dominant cycle. And the 40-day cycle is the cycle that I chose when I was learning Hurst cycles. And I got to the section where Hurst said, choose your trading cycle. I chose the 40-day cycle. So I have a fondness for the 40-day cycle. Here's the first alternative analysis, which has the 40-week cycle trough back in October of last year and the 18-month cycle trough in late August of this year. There's not very much difference between these two analyses. That is really the only difference. One of the things that this analysis does do is it does explain this really strong drop down here into the late August trough, because if this was going to be a trough of the 18-month cycle, then we would expect it to drop down with that kind of strength or lack of strength, I suppose. So this is the alternate analysis. I won't dwell on it very much. We also, of course, if we zoom in, we see exactly the same picture in the shorter term. Here is our very, very good 40-day cycle, up and down again. As William says, very, very dominant at the moment, very clear, beautifully shaped cycle. And that's obviously a 40-day cycle, and now we've seen price bounce up over here, rise fairly importantly last week to a new indicating that the current 80-day cycle is certainly at the moment has a fairly bullish shape. That's quite an important point, and so the next thing that we're expecting to happen is also exactly the same thing, a trough of the 80-day cycle in the first week of November. There's no big confusion here. My next trade is definitely going to be a short trade with the drop into that 80-day cycle trough. Let's pop up the composite model line. See, I think I've brought it down to 20 days here. Now, this composite model line, in my opinion, is a bit closer to the real price action. I think perhaps you can see that, but when we zoom out, you'll see it a little more clearly. This composite model line is a bit closer to price action. What does that mean? That Sentient Trader is performing a better forecast of the future. You need to be careful of that. What it does mean is that the analysis that is producing the cyclic model, the composite model, is matching price action more closely. And that means that a better analysis, not definitely, but it would increase your confidence in this analysis. As you can see, this composite model line is also indicating a drop from about, about 2055 down to about 1980. So that is 75 points. So it's a slightly less significant drop into the 80-day cycle. And the reason for that is fairly clear. If price is bouncing out of an 18-month cycle trough, then of course there is more bullish pressure. So any drop down into the 80-day cycle will probably be less substantial. Okay, the other analysis had only a 40 cycle trough at this position over here, so slightly less bullish pressure, and therefore a move down would be more substantial. I see a question from David. Trading Hurst, where is the previous 18-month cycle low for this analysis? Let's have a look at that. And if we zoom out, actually, before I answer that question, let me just show you the composite model line to this scale, and you can compare that quickly, and we can have a look at our slightly longer forecast. Then I'll go back to that 18-month cycle trough. If I forget, then just remind me. So it's the composite model line. I hope you can see it. Superimposed over price. I think you'll agree with me it's a better match for this price action than the other one, which means that the cyclic model that Sentient Trader has as a result of performing this analysis is it's more accurately fitting the actual price movement. And this is quite interesting because you can change the display of the price to align on median charts. Now you've got two lines, so you don't have comparing candlesticks with lines. Maybe it makes for a slightly better comparison. But anyways, just put those candlesticks back again. We have the same discrepancies in this analysis. You can see here the peak disappointed relative to the composite model. The composite model expected a bit more of a kick up in May. So, with the benefit of hindsight, we can see that May was disappointing for the markets, according to the cyclic model that we have here. And you can see the big drop down in August. The composite model shows us a big sort of descending line over there, whereas in fact price held up for some time, forming itself a bit of a triangle, and then dropped out of that triangle and fulfilled its cyclic destiny, if you like, by falling down to that position over there. So let's take a look at what this composite model is telling us to expect now and in the near future. First of all, of course, we've got the short trade coming up for the drop down into the 80-day cycle trough over here. Then we have the bounce up to a peak over here, which is in about mid to late November. And then we have a bounce up to another peak, which is in, I think you can see, the middle to late January. And then, of course, well, not of course, but then price is dropping down. So, in fact, even though we have two different analyses, the differences are so subtle that our trading decisions are exactly the same for me. I would be interested in going short for the drop into the 80-day cycle trough. I would then definitely go long for the bounce out of it. If the market is turning nastily bearish, then that bounce might be disappointing indeed, but it's worth, it's worth putting one on, as they say, putting one onto the markets and getting in there for to benefit from that bullish move. I am definitely going to be watching very carefully in January of next year, when both of these analyses seem to indicate that we're going to see the next peak, and that's a fairly long-term peak. Now let's zoom back and answer David's question. When was the previous 18-month cycle trough? There it is. I've pinned it here to February of 2014. In fact, I remember in February of 2014, I wrote some blog posts discussing that trough as a potential trough for the 18-month cycle. And it's a possibility. A really interesting thing happens with Hurst cycles. Many people approach Hurst cycles thinking, or hoping, I should say, absolutely black and white answers. This is the absolute truth, the gospel according to Hurst, and this is what's happening in the markets. I don't believe financial markets are like that. I believe that financial markets are fairly fluid, dynamic concepts, and it's almost impossible to state with absolute 100% certainty that you have the correct analysis. But the good news is that using Hurst cycles, even if you don't have the correct analysis, you can still make correct trading decisions. So that's the point I'm keep trying to make in today's webinar. Let's take a look at the other possibilities for what is happening here. And I know that people on today's webinar who have been watching this analysis and discussing it and tracking it, and I'm sure you'll have some comments to add to this. The next alternate or next possible analysis for the S&P 500 or ES futures, we go back to the 18-month cycle trough in October of last year. But we say the 40-week cycle trough occurred in early July of this year, as opposed to this big trough over here in August. Now, as John and David mentioned earlier, because the longer cycles are running shorter, and there's a sort of confusing mix there, because the cycles that are 54 months and 18 months in length have recently been running shorter. That means we would expect the 40-week cycle and other cycles to also run shorter. And that position for the 40-week cycle, let me just measure it again, is sitting at, that's at 264 days, the average length of a 40-week cycle. As discovered by Hurst many years ago, and I rediscovered it when I started looking at his work, is 274 days. So that trough, that cycle trough, came in 10 days short. So there are good reasons to think about this analysis, because that 40-week cycle trough could very possibly have occurred there at the 264-day mark in early July. It's a very valid analysis. Now, many people who are not familiar with Hurst cycles will look at this analysis and it will really bother them, because, let me just clear that, because we're talking about a 40-week cycle trough here, and price only moved down by that much. Okay, so I'm going to draw my M shape again. Do like those M shapes. There we go. So it's a very sort of skewed M shape, and it only dropped by that amount into the 40-week cycle trough. Following that, we had this huge. How is that possible? It's possible because of the way in which multiple cycles combine. And it's a very important thing to bear in mind when you're performing a Hurst cycles analysis, that the biggest, most prominent trough is not necessarily the longest cycle trough. It's quite an important thing to bear into the past. And after another year has elapsed and we're looking back, then we can more accurately identify that trough. And if there hasn't been a more prominent one since then we probably will say that was the trough of the 40-week cycle. But if, and this is just an if, and this is not a projection, if price comes down and drops sharply like that, then this trough that we're seeing is so significant in late August will disappear into insignificance because it has been overshadowed by more recent price movement. It's quite an interesting thing that I did when I was developing Sentient Trader was have Sentient Trader work out when it needs to perform a completely new analysis and when it simply updates its previous analysis. And one of the things that it does is it works out whether troughs that it identified previously have been overshadowed by recent price action. Is what happens is that if you take a look at this price action now, you say, well, this is obviously the really important trough. But the truth is we haven't had enough time elapse since that trough to really say that. It is possible, again, not a projection, but it is possible the price moves down as sharply as it did in August. And it comes down and forms another new low trough over here and then bounces up again. If that happens, then this trough won't be so prominent. The prominent trough will be this one over here. Okay, that was a bit of a ramble, but let's take a look at this analysis. I see some questions. I think I missed a question there from Sergio. The peak of January is going to occur with the 20-week trough. Okay, and I see Sam's answered that. Okay, great. Yes, peaks are an interesting conversation all their own, and again, we probably need to have an entire webinar just speaking about peaks. Now, this analysis that I have in Sentient Trader, this is the beta version of Sentient Trader I'm working with here, and it is able to perform what I call a dual analysis, which is a trough analysis and also a peak analysis. There's an important subtlety, because if you've performed an analysis, you could say here is the 40-week cycle, and therefore the peak in what is that, May? The peak in May is clearly the peak of that 40-week cycle. Okay, that's the logic when you look inside it as a trough-only analysis. You find the highest price in that particular cycle, and you say that is the peak of the 40-week cycle, and that is what Hurst typically used to label with his triangles. So that is a peak of the 40-week cycle. But now I've performed a dual analysis on this instrument, on this price data, and it has performed an analysis on the peaks as well. And so there's a subtle difference, simply identifying the peaks on the basis of a trough analysis and performing an entirely separate analysis on the peaks. And you can see this separate analysis has indicated that this trough in May that I spoke a moment ago as having only 40-week magnitude is in fact a trough of the 54-month cycle. In fact, I started writing blog posts back in, I can't remember when, it was actually end of last year, projecting when we would expect a peak of the 9-year cycle. And I initially said probably either March or I think October were my original projections made a year ago. I updated those projections in February or March and said in May, I think it was in May, I'm expecting that big peak. So when that big peak occurred, I was fairly sure that that was a peak of the 9-year cycle. This analysis shows a 54-month cycle because, of course, it isn't including the 9-year cycle in its analysis, but it's interesting to see that. But let me just turn off those peaks because that's really an entirely separate discussion, and sort of bring our discussion back to what we're speaking about today. So this is a very possible analysis. If we zoom in on the sort of short term, you can see that this 30-day cycle that occurred over here was a very bearish cycle, but there it is. It's got an M shape. And then here is the 40-day cycle that I mentioned earlier, is with question a 40-day cycle. No matter which analysis you look at, it is a 40 cycle. And but now something interesting has happened in the last week to challenge this analysis, and that is that price has formed a new peak. As price has formed a new peak, that means that we are looking at a bullish 80-day cycle. Now this 80-day cycle started over here at the end of August, according to this analysis. And this is a bullish cycle so far because it has a new peak. The peak of the cycle is very late in the cycle. Okay, this is where we expect the trough over there. So it's a very late peak. So we are, without question, looking at a bullish 80-day cycle here. I'm going to show you another alternative in a moment that presents a different possibility here. But that is very worrying in terms of this analysis. Why? Well, because bouncing out of a 40 cycle trough, we would expect to see a bullish 80-day cycle first, and then a bearish 80-day cycle, or less bullish. What we're seeing here isn't really making sense because we have a bearish 80-day cycle following the 40-week cycle trough, and then we have a bullish 80-day cycle. It's not really how we expect the markets to play out. It's not what should really be happening according to these cycles and according to this analysis. And instead of speaking in sort of abstract terms, I can now show you the composite line for this analysis. And you will see that this analysis, the composite line, is actually saying exactly the same thing as I've just said to you. And you can see here what the problem is. Here in the composite model line is the trough of the 40-week cycle. It then expected that cycle to play out over there. You can see that price itself was much more bearish, and the composite model line is telling us is now expecting another bearish 80-day cycle. Can you see that? You know, it was expecting an early peak to this 80-day cycle. There's the peak in the composite model. It was expecting an early peak, and it was expecting this peak here to be lower, to be significantly lower, in fact. So there's an illustration of how the composite model line really serves as a means of helping us to understand the analysis. You know, I've spent years looking at these diamonds at the bottom of charts and drawing squiggly lines all over the place and talking about what the analysis means. But what actually proves to be the easiest way of actually visualizing what the analysis is this composite model line, which is why Paul said, can I show the 80-day cycle zigzag? Yes, we'll take a look at that in a moment, although the cycle zigzag I've had problems with recently. It has some issues, but we'll take a look at that in a moment, see if we can do that. But let me quickly speak about what this analysis tells us to expect in terms of trading. This analysis is telling us that we are expecting price to move down into this trough in the first week of November. Isn't that interesting? So it's a really quite different analysis, but it's telling me to take exactly the same trade. Well, no, it's indicating the same trading opportunity. It's indicating a move down. In this case, a move down of about 110 points, as opposed to the other two possibilities, which showed us 70 and 80 points. So it's expecting a bigger move down. Why is it expecting a bigger move down? Well, because this trough in the first week of November, according to this analysis, is a 20-cycle trough, not an 80-day cycle trough. And when price moves in trough, of course, it's being pulled down by the cycles that are taking part in that trough. And so there's a 20-week cycle which is pulling price down. Okay, so it's expecting a stronger move down. So I'm feeling really quite confident about this short trade that I want to make into the first week of November. Let's see what's going to happen after that, according to this analysis. And if we can zoom out, there we go. Here you can see how the composite model line matched the price movement fairly well right up until it dropped out of the bottom of it in August. Can you see that? At that point, price sort of left the composite model line behind. Now, that doesn't necessarily mean that this analysis is wrong, but it does mean that our cyclic model that has been built as a result of the analysis isn't perfectly indicating what the action actually did. So it is something that needs to make us sit up and take notice. In particular, the fact that we have seen a higher peak last week, whereas the composite model line was telling us to expect a lower peak. That is an issue of some concern when it comes to this particular analysis. But let's take a look at the projection over the next few months, which I've been doing on all the other analyses. This one tells us there's a short trading opportunity coming up right now, exactly the same as the others. Then we have a good long trading opportunity. We're going to form a bit of a peak in mid to late November, as we did in the other analyses, but then it's actually going to continue higher up and form a peak over here. Now, where is that? That is in late January. And then price is going to move down again. Can you see, you can go back if you're looking at the recording, go back and have a look and see what I said about the other analyses. They're basically telling us exactly the same thing. So, we've looked at 3 analyses so far, and so far the trading opportunities have been identical. We have a short trading opportunity up now, taking us into the first week of November, roughly. Then we have a long trading opportunity for the bounce out of that trough. We are looking at the formation of a peak sometime in late November, and then a final peak in late January, after which we're looking at trading to the short side for the drop down into perhaps the middle of next year or perhaps slightly earlier. So the outlook over the next few months on so far all 3 of these analyses has been pretty much identical in terms of the trading outlook. Let's see if we can calculate zigzag lines and so it doesn't crash everything. And you want to see the zigzag lines for the 80-day cycle. There we go. So now the zigzag lines, and I know there are many of you who don't know what zigzag lines are because I haven't explained them except to the beta testers yet. Zigzag are quite an exciting new feature which show you the price movement, and so it's going to be too complicated for me to explain it now. But there they are, Paul. You asked to see the 80-day zigzag line. So here you can see the 40-day line is projecting up to this point. So it's much too high a projection. And here is the trough of the 80-day zigzag line, indicating roughly the same time period, of course, and roughly that sort of level down there. probably a little bit below 1900. I must reiterate that is, on the basis of this particular analysis, and this is not necessarily the correct analysis. We can look at the 80-day zigzag lines on the other analyses if you like. I have one more analysis I would really like to take a look at in the S&P 500, and that's only a slightly different analysis, but here it is. Now, this analysis positions the 18-month cycle in October of last year. It positions the 40-week cycle trough in July of this year, as in the previous analysis. The big drop into the end of August was the 40-day cycle trough, which might seem unlikely, but it is possible. And then we had the 80-day cycle trough forming there. Was that the beginning of October? End of September, I think. This analysis, let me sort of cut to the chase so that I can explain the difference with this analysis. This analysis resolved the problem that we saw in the other analysis of this higher peak over here, because as I mentioned in the analysis, that gives us a bullish 80-day cycle shape if we're still looking for the 80-day cycle trough. However, this analysis has an 80-day cycle, which is there, over there, and that is the 80-day cycle trough over there. So it is no anomaly that we have seen a higher price recently in the last week, because price is bouncing out of the 80-day cycle trough. And I see David at Trading Hurst says this is his favored analysis. Absolutely, it's a very possible analysis. It's a slightly personally, I don't mean to insult it, but it's a slightly inelegant analysis. It doesn't have the the beautiful picture element to it, but it's a very, very possible analysis. Let's not dwell too much more on it. Let me show you what the composite model line tells us to expect from this analysis, and then we can okay, and there we go. All right, so first of all, according to this analysis, we are also expecting, I see Sid also likes this analysis, okay, good. We are also, according to this analysis, expecting a short trade for the move down into the first week of November. So, I just love it. I can't say it often enough. Hurst cycles are a robust process, because using Hurst cycles, we've looked at 4 different possible analyses. You can pick your favorite. They're all telling us that the next trade that is worth making in terms of the point size move, is going to be a short trade into the first week of November. There's very little doubt about that. I'm fairly confident price is going to drop down into the first week of November. Not necessarily turning today, but certainly fairly soon. The size of that move here is a little bit reduced. It's only 60 points, as opposed to the 7 points and 80 points and 110 points that we saw in the other analyses. So it's less of a substantial move. So if this is your favorite analysis, then you would probably be interested in entering into a short trade, but you would keep a close eye on it, because you're not expecting it to move that far. Okay, you're going to be a little wary of it bouncing out of the 40-day cycle trough. So then, of course, our next trade is a long trade, which is going to form a peak in mid-November, exactly as the other analyses told us to expect. But let me just zoom out and take a look at the much longer-term picture. And there you can see our floating composite model line adjusting itself as we zoom out on the chart. So let's turn the pen around. It helps if I use the nib. And so here is our short trade that we're expecting now into the first week of November. Then we have a long trade into the November peak. And then we have another peak which forms, you guessed it, late January. Then we have a move down over here. And I could keep going into the future, but by the time we reach March next year, we will have had much occasion to re-look this analysis. So I'm not really worried about what's going to happen in March next year. By the time we get there, we can take a look at the evidence and what's going to happen. So that really is, is the punchline of this entire webinar. We've looked at 4 different analyses. They are, in my opinion, the 4 possible analyses. If there are others that you believe might be possible, I'd love to see them. We're not going to have time to explore them today, but we could explore them in future webinars. But the 4 possible analyses, in my opinion, indicate exactly the same trading opportunities. In other words, we have a short trading opportunity presented to us over the next few weeks. And as David at Trading Hurst says, the next short will be telling. That's exactly the point. As long as you know what your next turn is, what your next trade is, you get into your trade, you ride it, and you could be pleasantly surprised, as I was at the end of August with the D category short trade. Turned out to be the best D category I've made. Actually, no, I haven't made a better one, but anyway. But the point is, you get into the trade, and you let price show you what is happening. If it turns out to be a disappointing short trade, not a very big short trade, then this analysis will remain probably the favorite analysis amongst many of you. And our next trade will also be a long trade out of the first week of November to make a profit for that move up. All of the analyses tell us to peak towards the end of November, mid to end November, and all of them tell us to expect another peak at the end of January. And all 4 of these analyses tell us to expect a strong move down after the last week of January. So for me, that's enough perspective to plan my trading for the next few months. My trading in the S&P 500, of course. I'm sorry we've only looked at one instrument today, but I hope it's been valuable, because it's such an important aspect of Hurst cycles that even if you get the analysis wrong, you can still make the correct trading decisions. I often think that trading is a bit like driving along a misty mountain road. As long as you can see the next turn in front of you, you have a chance of surviving, because you know that you need to turn to the right or turn to the left. And we can see the next turn. The next turn is going to be a short trade. And we don't know what happens after that. So once we get into that short trade, we will watch it. And if it turns out to be a fantastically profitable short trade and the markets collapse on us, then all the better. Then we've made more money than we expected. And using that extra information, we can refine our analyses and probably work out which of these 4 analyses really is the most analysis and the best analysis that most closely price action. Let me quickly, have I missed any, let me see, I don't know if I've missed any questions. I want to quickly just take a run through. Let's take a quick look at the Euro-US dollar. Somebody asked about the Euro-US at the beginning of the session. So let's take a very quick look at the Euro-US dollar. And let me see if I've answered everything here. Stuart says, stepping back, we know from the spectrum the cycles are running shorter than normal, but these analyses all do not reflect that at the 18-month cycle. How can we trust these analyses and therefore draw predictive conclusions? I think, Stuart, that's a really interesting question. Let me just switch this window back again so I can see. There we go. Okay. It's a really interesting question when you have different analyses. I've mentioned, just go through these 4 analyses then for the S&P 500 and speak about that. According to this analysis, the average wavelength of the 18-month cycle is 16.8 months. And we don't have a 54-month cycle in this particular analysis. And here the 18-month cycle is 16.8 months. It is also fairly short. It's shorter than 18 months. And this analysis, the 18-month cycle, is even shorter. It's 15.4 months. So the point is, each of these analyses, some of them are telling us that the longer cycles, the 18-month and the 54-month cycle, are running very short, 15 and a half months. And the other analyses are telling us that the 18-month cycle is not running that short. It's only running 16.8 months. So there is therefore a difference in terms of your expectation for what is happening. it brings up a very interesting point, Stuart, and I'm going to try and explain my approach, which isn't everybody's approach, and I'm sure there are people on today's webinar who will indicate that they have a different approach, and so please do. Stuart says spectrum says. What about spectrum, Stuart? You mean the spectral analysis that you're performing? Is that the spectral analysis that Sentient Trader does, or a separate spectral analysis? Just a reminder to everybody, you can view your spectral analysis. Let's have a look here. Where is it? I've forgotten where it is. Okay, here it is here, and if we want to look at the monthly chart, here it's presented in what Hurst called a periodogram. And you can the higher sort of the higher lines there. I don't know if you can see it. It's very difficult to see, but the higher lines there indicate the likelihood of there being a cycle of that length present in the data analyzed. So okay. So Stuart is saying any process that you use to extract cycle wavelengths from the data indicate that the longer cycles are running short. Okay, so there's quite an important point to make. I'm going to try and explain my approach. I'm not saying my approach is correct, but this is which I've always used. When you start performing a Hurst cycles analysis, you perform what I call a mathematical analysis on the data. You perform a form of spectral analysis. Trader does a form of spectral analysis, which is interestingly enough based exactly on the process that Hurst used for writing his Profit Magic of Stock Transaction book. I know that because I actually had the pleasure of speaking to somebody who was involved in writing the report that Hurst used as for his original work, and they helped me to put that process together. Now that process, that was based on a process written in the 1960s. So it's a fairly old-fashioned and slightly out-of-date approach. Nowadays you get other software packages that perform more advanced spectral analysis. And some people have asked me, why don't I advance the process that Sentient Trader uses? And the reason is because, in my opinion, that information is useful as the starting point for an analysis. And of course, Sentient Trader cannot be all things to all people. It's not the ultimate toolbox. There are other programs that perform better spectral analysis, I have no doubt, and they're very useful to use alongside Sentient Trader. What Sentient Trader does, and it does it very well, is it then performs the phasing analysis, the cyclic analysis, using the approach that Hurst presented in the Hurst Cycles course. And using that approach in the Hurst Cycles course, the information that results from the spectral analysis is used as a basis for your analysis. And what that means is that you know from your spectral analysis that the cycles are forming troughs at certain time intervals. So let's say you know from your spectral analysis that following this trough, this 18-month cycle trough over here, your spectral analysis tells you to expect the next 18-month cycle trough to occur early, perhaps. I'm just using a simple example here. But your spectral analysis tells you to expect it early. There's a subtle difference between experiences a trough and when that trough manifests in price. It's a subtle thing, and we don't speak much about it, but it's actually quite an important point. If a cycle forms a low point, and whatever a cycle is, but if the cycle itself is forming a low point, and you can use spectral analysis and bandpass filters and so on to identify the times at which cycles are forming low points and when they're expected to form low points. But Hurst's approach in his cycles course, and the approach that Sentient Trader software takes, is that is useful information. Of course it is. It's vital information to know when the cycles are forming troughs. But what's useful for making trading decisions is then to work out where those cycle troughs manifested in price. And that's the approach that Hurst presented in his cycles course. So you use the results of the spectral analysis to gather when you expect the cycle to be turning. Now, I believe that markets are not. You've probably heard of the efficient market hypothesis and all that kind of thing. I believe that markets contain a great deal of sort of human emotion and a little bit of randomness and a bit of unpredictability, which is what makes them fascinating. And so when the cycles that influence price movement, which is it's one of the reasons why I'm very careful to use that word, cycles influence price movement. And when the cycles that influence price movement turn around, what sometimes happens is that price turns around before or after that, because a little bit like a ball in a pinball machine, and the cycles are the flappers, that are sort of pushing the ball one this way and that way. And there are various other things involved, obviously human emotions and world events and all that kind of thing. And so as a result, we get a distinction between where the actual cycles form a trough and where price forms a trough. And in my opinion, what is useful is you want to perform an analysis and identify the position of those troughs in the price action, because on the basis of that, so where the cycle troughs and the cycle peaks manifested in price action, because on the basis of that you can then make a trading decision. You might be more of an analyst than a trader, in which case perhaps more interested in the sort of real core cycle values, or you might be more of a trader. And I tend to be a mix of both, as everybody is, but I tend to favor more being a trader. And so I'm more interested in where price manifested the cycle troughs, if you like. And it manifests cycle troughs in not the perfect place often. It manifests cycle troughs in slightly imperfect places because the markets are not perfect. And so I hope, that's a really long approach to that answer, Stuart. I find the results of any spectral analysis very interesting and very important to base my analysis upon. But then I put it in the background of my mind, if you like, and I look at how those cycles have manifested in the price action. And, that's why I found the Hurst Cycles course so useful. I found it more useful than the Profit Magic book as a matter of interest, because in my opinion, that's where Hurst took that move from, performing a mathematical analysis and then taking that mathematical analysis and performing more of a sort of a dynamic, flexible, fluid analysis of the price action, and it's a pattern recognition analysis. So to get back to Stuart's original question, which I've now lost, but I can find it over here. We know from the spectral analysis or the spectrum that cycles are running shorter than normal, but none of the analyses that I've shown reflect that at the 18-month cycle level. So how can we trust these analyses, first of all, and therefore draw predictive conclusions? Well, first of all, it is an example of taking a slightly different approach to the analysis. The results of a spectral analysis are, in my opinion, useful, but I tried for years trading on the results of the spectral analysis thing, where it says the troughs would be. I found it very hard. The analysis that I learned to trust was an analysis that's based on pattern recognition, using the processes taught in Hurst Cycles. That produced an analysis that I could really trust and that I could make trading decisions on the basis of. What you will usually see is that those analyses do, over time, get to match and they get to reflect the results of the spectral analysis, but there are differences, and you're pointing one of them out now, Stuart, but I do believe that you always see discrepancies between your pure spectral analysis or your pure mathematical analysis and an analysis performed using a pattern recognition process. I think it's probably really important that you keep an eye on both of them. I think they're both really useful approaches. I don't rule one of them out and the other, but I've learned to trust this analysis process, and I find it very useful. And I, in particular, find it very useful for making trading decisions, which brings me back to the point that I've kept trying to make in today's webinar, which is that in terms of making trading decisions, all of these analyses are really indicating that we should expect the same kind of trading opportunities, and that increases my trust in the analysis. The fact that the cycle wavelengths that have manifested in price differ from the results of the mathematical spectral analysis process isn't something that worries me. Perhaps it worries you. I don't know how to set your mind at rest. It actually bothers me, because I think it's purely an example of the fact that when it comes to the markets, we're never dealing with perfect information. We're dealing with imperfect information. It's like we're driving down that misty road on a mountain top, and we can only see a certain distance ahead of us, and we can only see a certain distance with any clarity behind it. There's a lot of randomness in there, human emotions, market manipulation, goodness knows what, to sort of change things a little bit. Alain says, I see there are a whole lot of questions that I've missed while I was banging on about that. Right, is a low point or trough a composite one? So Alain, that's yes, that's an interesting question. Does price form composite troughs? In other words, or do cycles cause different troughs close together? It's the principle of synchronicity, and in my opinion, the principle of synchronicity does apply, particularly to stock markets. And so, if that's what you're asking, I hope I understood your question correctly. And William says at the short trading cycle level, the difference is immaterial. Okay, so I think William's speaking about the difference between the manifestation of the cycle troughs in price and the result of spectral analysis. He's saying at the short trading cycle level, the difference is immaterial, which is good news. Kevin, the S&P has trended upward for the past 7 years. To form your composite line from the individual waves, do you reintroduce this trend component back into the line to get it to fit the trend upward? Kevin, the composite model line is a result of all the cycle information. So yes, any trend, any cycle information that the software has, if I zoom all the way out on this and go out to a weekly chart, perhaps even a monthly chart, there we go. There's our composite model, and so all of the cycle information that the software has is included in that composite model. Where the composite model line deviates from price movement, that indicates that there was some influence on price that was not a part of our composite model. Okay, in other words, during that period that I've drawn a little circle around, you can see price was much more bullish than our composite model, although the composite model line caught up with it. But for some time it deviated from that composite model line, and so what tends to happen is that there's something influencing the market during that time, which is not included in our cycle model, whatever that is. I don't know what it is, but our cycle model does not explain that price movement perfectly. Kevin says we consider some very long cycles. Yes, absolutely. Hurst defines something called sigma L, the Greek symbol sigma, which stands for the sum of, and L. L stands for all longer cycles. So sigma L is the sum of all longer cycles, and by that we mean all cycles longer than the longest cycle in this analysis. Okay, so sigma L is basically very, very slow, very long cycles. We don't know what cycles they are. They might be 36 years, they might be 54 years, it could be the Kondrativ cycle. Who knows what cycles they are, but it's the sum of all of those cycles, longer than the longest cycle that we have in this analysis. And Sentient Trader does in fact work that out now. It's something that we are testing. And so with some trepidation, I pull up Sigma L. This is what Sentient Trader has calculated for Sigma L. I'm going to draw over it. That greenish line is the so that's what it's worked out for Sigma L. So in other words, the sum of all longer cycles, according to this analysis, has been moving up since, what's that, 2010. And it's expected to form a peak. Sigma L is expected to form a peak probably sometime next year. Okay, I can't go into detail about how that's calculated. It'll take me, I should probably do a webinar just about that. I will do that. See, poor old is it Vigantas asked about the euro. Let me very quickly show you the euro US dollar. The euro US dollar is a fantastic instrument to trade at the moment. I hope you're trading it, and absolutely loving it. Because the cycles are really clear, in my opinion. We don't have time to really talk about this analysis, but it's the same analysis I presented you with previously. I have a very long cycle trough, 54-month cycle trough that formed in March of this year. We have a 20-week cycle trough that formed in, July of this year, and an 80-day cycle trough which formed in September. The next sort of big event for the euro is that we're expecting this 40-week trough over there. There's the nest of lows. That's expected, look like late November, perhaps early December. So, of course, I used to say, okay, well, now we're expecting price to drop down into that trough and then bounce out again. But I don't need to do that anymore because we have our nice new composite model line. And if I show you the composite model line there, you can see how the composite model line, our composite model has matched price action very well recently. Oops, let me clear that. It has recently dropped away a little bit over there, and it's been struggling to reach this point over here. But according to this analysis, we are expecting a peak to form soon. And it's very important that Hurst cycles tell you when to expect something. You mustn't, jump on it straight away. But it is possible that peak did occur last week. It's absolutely possible. And then we are expecting generally bearish movement with a few wobbles down into this 40. At which point, according to this composite model, expecting a really sharp, good, long, bullish trade. So early December, prepare yourself to be trading long in the euro, but it certainly looks as if though we should be trading short over the next short period. Here's the other analysis that I have entered previously for the euro US dollar, and this uses a different model. I won't go on at length about it, but you can see this composite model line matches the price action more closely. Let's just zoom in and see what's expected here. Here we see not such a bearish move, although we do still have a bearish move ahead of us, but not such a bearish move. You can see it's a much shorter lived bear move for, where's my pen? There we go, a much shorter bear move there, then a bit of a bull, then another, and then here is going to be a long trading opportunity. So in the euro US dollar, we should be bearish at the moment. I think there's no question, both analyses show us we should be bearish euro US dollar at the moment. We would have probably needed to get in last week. One analysis indicates we have further to go and it's going to carry us through the whole of November. The other analysis indicates that we probably aren't going to see a significant drop. We're going to see a bit of a wobble, but the really interesting trade in the euro is going to be this long trade here. So we need to be standing by. That's in middle to late November, and we need to stand by either middle to late November or early December for that long trade. So when you get a discrepancy like that, slightly different time periods, watch the markets closely, and as we get closer to time, get ready for that long trade. It looks like it's going to be a long trade that we don't want to miss out on. And as Robin says, that seems to fit predictions in gold too. Yes, exactly. We're looking for a good move up probably towards the end of this year in gold. We have seen quite a good move up already, of course, but you'll know from John's discussion 3 weeks ago that long trade in gold is probably going to be a really important one. Well, thank you very much for joining me. I hope I have answered as many of your questions as I possibly can. We really are running out of time now. It's nearly 3:30 in Europe, and the American markets are going to be opening. So it's time for us to turn our attention to those markets. And thank you very much for joining me. I really appreciate your interest in Hurst Cycles and in Sentient Trader. I'm really enjoying doing these webinars. Thank you so much for coming along to them. When I end this webinar, you should be redirected to a page that allows you to register immediately for next week's webinar, which is really useful. This whole process of registration is just really tedious. So, you might need to refresh your page. Sam told me that you need to refresh that page.